Over the last week or so, you've seen me have many a conversation with residential investors, Jason Pritchard, Adrian Hernandez, and many, many others. We've been talking about what does it mean to have higher rates for longer. In those conversations, we were talking about perhaps having 7% mortgages for 30 years. What does that change on the buy and the sell? In this conversation, we're going to go one level deeper. We are going to talk to somebody who plays in the commercial, AKA multifamily space. We're going to talk about the fact that higher for longer, what it might mean in that space. And folks, buckle up. Hey, Jonathan, how are you?
I'm great, Michael. And I just want to say it was so great seeing you last week here in New York at Lance Lambert's conference. We got to have lunch together. So that was a big treat for me. So great. Never get to see you in person. So it's great seeing you.
Yeah, Lance, thank you for that again. Yeah, it was a great opportunity for me. I got to spend a day and a half with my daughter, which of course was the highlight. Got to see you in person. We've been having weekly conversations for 3 years. So it was nice to meet you. And of course, thanks for lunch. You bought. So
absolutely. No, it's at least I could do for all these years of appearing on your channel. So it was great fun to see you.
Yeah. So let's paint the picture. So again, if you rewind the clock about 8 weeks, at least on the residential side, people were starting to talk about, starting to get frankly giddy that they were saying, mortgage rates are going to go from 6.1 to 5.5. I knew significant players making business plans that had 30-year mortgage rates at 5.5 by the summer. And I pulled them aside personally. I created videos. I'm like, guys, you're smoking crack. This is not the setup that I see coming. And, thankfully, I was right. A lot of them went back to their business plans and remodeled it. But I wanted to come to you because we just had our second of 2 rate cuts. They've cut 75 basis points, a 50 and a quarter. There is a 76% chance of a rate cut in December, which will bring the total to 100. I know there's some people saying no cut, but what I'm starting to hear over and over again is pause, meaning we may be at this neutral rate at 4.25 instead of 3.25. And I think that's going to have huge implications in the commercial and multifamily space. And I wanted to come to you and see what you thought.
Yeah. So, well, first of all, just sort of backing up those 8 weeks, the conversation in the commercial space was a little bit different because it was like we got the cuts and then the long end of the curve went up, right? And I think that came as like a big shock to a lot of people. Now, not to really experienced bond traders and stuff like that who didn't seem to be surprised by this. But I think a lot of the people in the commercial real estate space, especially people who were basically under 40, who have never seen anything other than a really low rate environment for their entire careers and think that that's normal. I think that they were just waiting for mortgage rates to drop, for us to, suddenly enter into a bull market again. And then when the long dated rates actually went up, I think that's what got people to finally start to realize that hey, there's a lot more that goes into like a multifamily mortgage rate and a multifamily cap rate and all these things than just whatever the 10-year treasury is trading at, right? Yeah. And whatever the Fed overnight funds rate is. So it's like, I think I stopped seeing so much of the triumphalism and the giddiness that we were seeing actually before the Fed cut rates, but when it was just talking a lot about cutting rates, everybody was anticipating it. Now, of course, here we are post-election, and we see what, the incoming Trump administration as saying it wants to do, whether it's able to do it or not, that's always an open question. But what it's saying it wants to do is incredibly growth oriented. And with, it seems it's kind of like an all out, pedal to the metal emphasis on growth. And you just don't get that and also maintain a low inflation, low interest rate environment. Like those two things just don't go together. Yeah. Right. So, and I think one of the things that we've seen, over the last 10 years, one of the things that I think has contributed to a lot of this is that the Fed, after the great financial crisis, it was more worried about deflation than anything else,
Correct. It
right?
was.
It looked at the example of Japan. It looked at what happened in the Great Depression, and it was like, we just have to
Yeah.
do anything.
We don't want that.
Yeah. We just have to do whatever we can to avoid deflation. Now, you can argue with them as I do, and you and I have, that they probably, pumped too much fuel into the system for too long, right? They should have kind of pumped the brakes quite a number of years ago, but they didn't. And of course, that led to inflation eventually, as it just inevitably does, right? So, and here we are. Now they've got to tamp that down. And so now we've changed. Like, there's been a phase shift in the economy where deflation is no longer the concern. Inflation is the concern once again. And when you go both as, the Biden administration having huge fiscal spending while inflation was starting to run hot because that was part of the agenda, rebuild the infrastructure, right? Now you've got another administration coming in saying like, hey, we're going to like amp it up even more with a bunch of tax cuts plus a bunch of spending, and it's all going to work somehow. But either way, it's going to fuel growth.
Yeah. This is why I think the Fed is in. This is why I think, again, I've been telling people, I think 2025 is going to be rough because of higher for longer. I mean, there's a non-zero chance, Jonathan, that we have 0 rate cuts and frankly 0 rate hikes in 2025.
Yeah.
And I think if you rewind the clock even two months, that would be heresy, right? People would be like, you're kidding me.
Right? Oh, no. I mean, no, people were predicting another full point of rate cuts at least next year. Right. Yeah. So, and that's just off the table now. I mean, unless we have a crash, right? In which case, I mean, we want to talk about the impact of this obviously on commercial real estate, but there's kind of like right now, I would say commercial real estate is in kind of a damned if you do, damned if you don't situation.
Okay. Tell me more. I don't understand.
Well, in a sense. Okay. If you're buying property now, this doesn't apply to you. If you own property already and you bought it at the top, then really there's no good option going forward.
No
other than to grind it out for as long as you can, hope that your bank will extend your loan until NOI growth grows enough that you grow your way out of the problem. And that is a long-term thing. That is not going to happen overnight. If you're looking for rate cuts to save you, well, sorry, you're SOL, right? Yeah. I mean, it's not, rate cuts are not going to save you. And they never were, because they never were going to cut enough to save you. However, on the flip side, if they do cut enough to save you, well, it's because the economy is now in the crapper, and that's going to hit you on the rent side. So there really isn't, if you buy at the top of the market and you overpay and you over leverage, you're
supposed to lose. That's going to lose. The system. Yeah.
You're going to lose, right?
Yeah. The big thing that I see in this, Jonathan, is I think there was a general feeling, and we saw this with a lot of debt extending out a year. There was something like $1 trillion or thereabouts in debt that was supposed to mature in 23 that they pushed to 24. I think that's going to start coming off the table. These banks, and it's really the commercial banks, the smaller banks, I think they're going to be forced to recognize that this asset is frankly worth less than the debt, and we're eventually going to have some real opportunities to buy, basically to have assets trade ownerships. That's what I think is coming.
Yeah, I mean, I think that, listen. So what did they do in Japan when they had their huge debt crisis in the 90s? They rolled it over and rolled it over and rolled it over for
they
years.
Basically privatized the debt kind of at the country level.
Yeah, they just kind of kept on rolling it over and rolling it over, and until kind of eventually it wasn't such a problem anymore. But it took years, and it was a drag on growth, and they've had growth problems ever since because of that. I hope that doesn't happen here, but I think that it could. But I mean, because at least I think the banking industry could be in a kind of slow grind for a very long time, and that's going to hurt commercial
Exactly.
real estate.
Exactly.
Right.
Again, I think they're, we were pontificating and guessing that what we might be going through eventually was akin to the savings and loan crisis. And again, the savings and loan crisis was not one cataclysmic event. It was 9 or 10 years of a death by 1,000 cuts. We didn't lose 1,000 banks in a month, a year. It was over a decade. And that's exactly what I think is coming, is this higher for longer is going to ripple through the banking industry. And we're going to see onesie, twosie banks get bought, merged, whatever, because they have localized debt problems. I mean, we're seeing more and more, and these are usually office buildings, sell for 70% off.
Yeah. Yeah.
Not that we're going to get 70% off in multifamily, but if you're in class B, class C, it could be 30, 40%, I think, pretty easily.
I mean, listen, so the advantage that multifamily has over office is that multifamily is by and large full wherever you go, right?
Pretty much. Yep.
And there are some markets in the Sun Belt that have been overbuilt, but that absorption is happening. Like in another year or two, there will not be an oversupply problem in those markets, right?
Agreed.
And construction is more or less stopped because they're currently in oversupply. That's the way it works.
Yep.
So I think if you're a bank, you're looking at those multifamily properties and you're really making the decision, okay, which of these do we just have to kind of suck it up and wait, right? And then which of these are we going to cut our losses because we don't believe in the operator, right? Or we're going to force the operator to sell. And that's going to be the decision. So, and then of course, that's going to slow down lending. And there's going to be a problem with if they have a lot of exposure to office, that's going to slow down lending too, because they're going to have to sell all that stuff off and rebuild their balance sheets before they're really able to engage in a lot of lending again. So there's going to be a lot less liquidity in the market in general. And I think it's going to hurt everybody in commercial real estate, regardless of what your asset class is.
I agree.
And people are going to have to go to alternative lending sources other than banks, which charge a lot higher interest rates. Right. So if you're going to go to private equity, you're going to go to any kind of private lending, bridge debt, whatever, those interest rates are going to be pretty unpleasant. And it's going to be hard to get deals done unless prices come down. That's really
that's going to be the reason. That again, this is wild to me as somebody who lived through the Great Recession and has pointed out the fact that I think commercial is going to go through the same crisis. Yet again, this is similar. What do I mean? One of the reasons we saw such huge price degradation in residential is because banks pulled back. Banks started implementing rules like, hey, you can't have more than 4 loans, which in an environment where there's only a few active buyers because everybody is scared, met guys like me had to go get 12% hard money.
Yeah.
So guess what? I can't pay as much when I have cost of capital at 12%. If that happens in commercial, which I think it will, right? They'll pull back. They won't lend. We're going to go to cost of capital at 9, 10, 11, and we're going to have to pay less because we're not going to make the same mistake. We're going to make sure it cash flows day one at the cost of capital that we can get. So losses will be even greater because they pull back. It's shocking how similar this is.
Yeah. And that point that you make about having to cash flow day one is really important, because I think that so much of what was happening, especially at the top of the market, was people were flipping deals and they really weren't concerned about cash flow, because they were just with houses in 2006 where people, they were like, oh, the rate's going to reset, in 2 years. Well, I don't care because I'm going to sell it before then and I'm going to make more money. Like that was
same thing.
That became the attitude in multifamily because a few people had exited deals so quickly and made such huge IRRs that became the expectation. And once you get into that stage of the market, you're really basically into like a musical chairs situation.
No, it's exactly. Again, it's the same thing. I knew guys in 06, 07 who were flipping contracts. They didn't even own it. They would get the contract, they'd lock it up, they would sell it to someone else for 25 grand. And again, it is absolutely musical chairs. Bad debt structures, short-term, high rates, bad operators, stupid assumptions. Now we're going to have on the backside, we're going to have banks pull back. You're only going to have a few. Can you imagine? Like, let's say, for example, 2021 was 100. Right? What do I mean by 100? Meaning that was the activity level, the buyer interest was 100. if we go to 2026, buyer interest might be a 12 because everybody got burned. They've all pulled back. It's now an asset they don't want to touch. There's no access to private money. But guess what? I want to play in a market where it's 12, not 100.
Yeah. If you're a buyer
shocking.
and you get, and frankly, look, I mean, if it does go down to 12, then, you know, paying 12% interest isn't going to be a big deal because you'll get such a discount on the asset, right? That, and then you know that interest rates will come down, or at least liquidity will rise eventually, and then you can refinance out into better interest rates, right?
As long as, again, I tell people all the time, as long as the building cash flows or house, right, depending on what you're buying day one, and your cost of capital is fixed for a long duration, so you don't have that time pressure. That's like magic, you know?
Right. And that's why so many people got into trouble at the top of the market, because they were using funky debt and too much of it, right? Mm-hmm. The people who kind of bit the bullet and got fixed rate debt at a slightly higher cost in 2022, they're fine. They're not making as much money as they hoped, but they're not looking at foreclosure. They're not making capital calls on their investors. They're just not really loving life, but they're going to be fine. They'll be able to ride it out. But you just see this at the top of the market every time, where cap rates get compressed, people are desperate for yield, and they start doing bad financial engineering in order to try to get more yield. That is going to include stuff like variable rate debt. And it also is going to include stuff like preferred equity, right? And this is another thing that we're going to see happen. I think a lot of LPs don't really understand the power. It's not just that the preferred equity sits on top of them in the capital stack, right? It's that those pref lenders have the ability to force a sale, right?
Exactly.
And so what will happen is that as soon as property values recover enough that the pref equity can be made whole, those deals are getting sold and the LPs are getting wiped out, right? Because the pref equity doesn't care and it has no fiduciary duty towards the LPs. It's just going to force a sale at that point. And so a lot of LP equity is going to get wiped out, and they're not even going to realize like why they're getting wiped out, why these sales are happening. And I think a lot of those people will be out forever, and that will further depress liquidity in the market. You know, it's already seeing it. You're already seeing the LP equity really scared, and that's just going to make it even worse.
Yeah, it is amazing to me how similar these two events are going to be. And again, switching gears to the opportunity. Again, I think there's going to be tremendous opportunities to pick up assets that cash flow day one at significant discounts. Again, that if you're able to hold for a decade, right, you build that into the plan, right? You don't have any forcing functions with preferred equity or, loan covenants or anything. You're just going to crush it. Yeah. It's going to be relatively easy.
And excuse me. And I think, this is why, if you're trying to break into multifamily right now, right? Here's what I would say to you. I would say, don't get distracted by stuff like syndication, trying to do big deals, or any of that other stuff. What you really should be looking for is deals that you can take on yourself, or maybe with a couple of friendly investors who are not going to be saying, I need my money back in 5 years or whatever. Like, go in with some friends, go in with some relatives, and do it the old fashioned way. Yeah. Like when I was a lawyer, we used to have, I remember people would be coming around the office saying, hey, there's this building for sale downtown Manhattan. Well, let's all go in together and buy it. Right. That's the kind of thing that you should be looking for, because there's going to be deals. And then you have patient capital, because you're not like trying to make a return for somebody quickly, or people are not depending on that, that income, right? They're willing to be able to look at that as a long-term appreciation. And if you do that, you will do very, very well. And then you can always go to syndication later when the market kind of heats up again and there's a new generation of LPs looking to invest passively. But I think now is the time to think small and strategically.
Absolutely love that. I think, again, that's where Olivia and I started. Again, you can learn so much on the small deals. And I just love that advice. You actually have a school community focused on multifamily and apartment investing. It's school.com/AIC. What does AIC stand for?
It stands for Apartment Investors Club. So
Oh, shocking.
yeah, shocking, right? So if you come to Apartment Investors Club, you'll learn. And the thing is, it's I talk about syndication because people want to learn how to do it, but that's only a very small part of what I talk about. Mostly what I talk about is how to find deals, how to buy them right, how to underwrite, how to understand how these deals work so that you approach them the right way and you don't get burned. And I have to say, this was advice that people were not really that interested in hearing at the time.
They were not open to it. No, they
really
weren't.
were.
We got poo-pooed for telling people to be cautious. I remember
exactly.
those comments. Yeah.
And it was, if you're a conservative investor like me, it was tough being in the market in those years because it was almost impossible to compete and find decent deals to do. So, but now, if you are a patient, conservative, long-term investor like I am, this is your time. Your time is coming.
The sun is rising. The sun is rising. I look forward to the opportunity. I look forward to talking every week because, again, I think guys like us who were out of the market for a couple of years when people got nutty, we have the reputations we can raise if we want to. Yeah, I look forward to the opportunity to double or triple cash flow net worth if I so choose to do. Again, folks, go check them out. School.com/AIC. Jonathan, thank you so much.
Thank you, Michael.